Hi, this is Hutch with bankingtruths.com, and today we're going to tackle the frequently asked question of, do I have to borrow from my own bank or can I just make a withdrawal? And I'll tell you straight away that no, you don't have to borrow from your own bank, and yes, you can make a withdrawal. However, there may be some clear advantages to utilizing the borrowing feature. And in order to demonstrate that, we're going to look at a mathematical example. But before we do that, we're going to start with the concept on a sketch pad. So let's first start by dissecting the concept of debt so that we can later differentiate it from the mechanics of the banking strategy. So if somebody's even and they have no savings and no debt, in order to make a purchase, they're going to need to use somebody else's money. We're going to represent that here with the red line, bringing them below even. Now this is debt. Interest is going to be accruing on this, and so in order to keep things from snowballing out of control and to keep their credit in good standing, they're going to make principal and interest payments to get themselves back to even. And by having that credit worthiness, if they want to make a later purchase later in life, they can again use somebody else's money, but again, they're going to have to make regular principal and interest payments just to get back to even. Now, the alternative to this is to save your own money so that you don't have to use somebody else's. And so we have to start back here in time because you do have to spend some time and energy accruing your own money so that you can make that same purchase. And even though you don't need to make that principal and interest payment to get back to even, you still need to make regular payments back to your savings account. And I call this P minus interest because most of them aren't paying very good interest at all, and what interest they do pay starts with a dot. But you need to make these same payments to fill up your bank so that you can make the next purchase. And so the story goes. So what I want you to notice is that even though you're on the right side of the line here, you're really not making any progress with this block of funds. Well, what's the alternative, you ask? And I think we'd both agree that the holy grail would be if we could put our money in an account that would safely compound interest for us. And if you remember what compounding is, I call it it's P plus I plus I, because not only do you earn interest on your principal, but after 1 year goes by, you earn interest on your principal and you earn interest on the interest that your principal has already earned. So you get this wonderful snowballing, steepening effect of this curve over time. Now, I ask clients, would you rather have this side of the curve or this side of the curve? And everybody wants the far right. And there's no magic bullet that gets you there. It's really just allowing that money to snowball like this over time. If we had this account and we could collaterally borrow against it at any time for any reason, even if you did fill up the tank again by paying off that loan you have against your compounding asset, there's really no love lost. And in fact, you end up at a higher place in line so that you can do it again. And if we compare this to our saver, even if we use the exact same cash flows, you can see the difference is staggering here. Now, I know some of you are seeing these red lines and hearing the word borrow, and you're literally seeing red. You've worked very hard to get out of debt, or you're in the process of working very hard to get out of debt, and I commend you for that. But is it technically debt if you have a corresponding asset that's growing right alongside of it? So getting back to the original FAQ of, do I have to do all this borrowing stuff? Can't I just withdraw my money? This account sounds great. And the answer is sure. But that defeats the purpose, because as soon as you make the purchase and drain the account, you kill the compounding. It's gone, right? It's not happening anymore. It doesn't matter how great the account is or what kind of interest you're earning, because you're down here. And by the time you fill the account back up, you're behind where this guy could have been by not interrupting the compounding in the first place. And the only way to do that is to have a feature in the contract that allows you to collaterally borrow against your compounding asset at any time for any reason. What I found is these semantics really cause stumbling blocks for even my most successful clients. And what I'm about to show you is a mathematical example that will hopefully demonstrate that if you can get past the mental notion that the word borrow automatically equals bad, that you'll be able to put yourself in a better financial position overall by using this financial strategy. Okay, so what we're looking at now is an actual policy designed for banking from a very reputable company. And I do want to disclose that these are non-guaranteed values. And so what it's assuming is the company is going to continue to pay dividends every year going forward with the current dividend scale. And that could be good news because the current dividend scale is historically pretty low considering our low interest rate environment. And although there's no guarantee they'll continue to pay a dividend, this particular company has paid a dividend every year since the mid 1800s. That being said, what we're actually looking at here is a 43-year-old, it says 44, but this is at the end of the year, a 43-year-old at the second best rating taking out this policy. And we're going to fund premiums for only 7 years. So you could pay for longer and you probably should pay for longer, but you don't have to. And in fact, if you wanted to get away with only 5, you could probably do that too. And the minimum premium that's due for this policy is less than $6,000. But if you want to fund the full 25 and you do want to overpay the minimum so you can build up as much cash value as possible, the IRS requires us to have about $925,000 of death benefit. So this is almost the minimum amount of death benefit that the IRS will let us have to fund this $25,000 a year for 7 years. Now, going forward, after the premiums are done, you can see there's a negative here, and this is in the total net outlay column. This means we're taking out a $140,000 policy loan. And then after that, we're going to pay back 7 $20,000 payments. So there's 1, 2, 3, 4, 5, 6, and there should be another one here. And there is actually, but we're also taking out another 140. So this last $20,000 payment is stepping on the $140,000 loan. And so the software nets it out automatically. And then we're going to pay back 720s. Here's 5 and here's 2 more. So this is essentially a mathematical representation of the green line, building up this $175,000 of premium, $25,000 a year for 7 years, taking a policy loan of $140, paying back just principal of the $140, taking out $140 again, paying back just principal of the $140, and having this full $175 compound the entire time, regardless of the policy loans for purchases. Now, we're going to compare this to, we have a separate calculator where we can plug in $175,000 into a cash account, taking out 140, putting the 140 back, taking out 140, putting the 140 back, and seeing what this ends up to. And our benchmark, we're going to use the year 23 numbers, so age 66. And we're going to look at the net cash value at the end of the year. In this case, it'd be $350,000. We'll just go ahead and round down. And we'll look at the net death benefit at the beginning of the year. In this case, $877,000. So just write down those two figures, the 350 and the 877, because we're going to plug them into a different calculator now. All right, so this calculator is going to take the data that we ran, and over here we're going to plug in the policy inputs. So this is going to be our policy side, just like we saw, look like this. And over here is going to be our cash side, and you guys are going to help fact check my work. The annual payment we paid was $25,000, and we did that for 7 years. And we made a purchase in year 8, and we did it through a policy loan of $140,000. Now, we paid back $20,000 for 7 years, and we did that twice. We're going to notate that over here. And in year 23, the policy cash value was just over $350,000, and the policy death benefit was $877,000. Okay, so there's a lot going on here, and we're going to play with some of these assumptions in real time, but I want you to notice that I gave this wonderful savings account a 5% rate of return, and I said our taxpayers are only paying 35% between state and federal taxes. I realize some of you may be paying more and some of you may be paying less. What this term cost is if you wanted that initial $925,000 of term to last for 20 years, it was actually more than $1,000 with the cheapest company out there, but I just went ahead and rounded that down. And again, we did 2 cycles of this, taking 140 out of the savings account and putting it back 20,000 at a time. And at year 23, the term would have lapsed, so there'd be 0 death benefit in spite of paying for the term. And notice that how much cash you had would be just under $250,000. This in contrast to the policy that even at today's low interest rates was $350,000, and there's $877,000 of death benefit there that will endure, and it'll grow or shrink depending on how you use the policy, but it doesn't lapse after 20 years. So some of you may be saying, you know what, Hutch, I'm in a state that doesn't charge state tax, and I'm a fairly modest earner, so I only pay 25% in tax. And you know what, I don't have any kids, so I don't need to pay for term. Just notice that the cash account is still less than the cash value in the policy. And the reason just comes back to that allowing this asset over here to compound no matter what, even in spite of the policy loans, versus over here, you're filling it up, taking money out, filling it up, taking money out, filling it up. And if I press this button down here, we can go ahead and take a look at a spreadsheet depiction of that. And I think it's really impactful to see exactly what's going on. So again, this is just the savings account we're looking at. And if you put in $25,000 a year at 5% annual growth, you see you're getting $1,250 of growth. And granted, you have to pay some tax, this $312 of tax. But let's just focus on this column for a moment. As we fill up the account, notice what happens. Our annual growth, how much we're getting every year, really gets up to some nice critical mass, up to about 10,000 of compounding in that 7-year. And then what do we do in year 8? You pull out 140 of it, and what does it do to the compounding? It just crushes it. And even though you're going to fill the bucket back up and your compounding will go back up, and you get up to that 10,000 again, what happens right here? You take out another 140 and you just crush it. So the reason why our strategy over here is much more powerful is you are able to compound that full balance without crushing it. And let's just go ahead and put a realistic rate of return here for a moment. Let's just use something closer to what people are actually getting, like 1. And again, this is at the lower tax rate with no term. We're talking about an extra $150,000, $155 and change $1,000 created out of thin air simply by repositioning your money and funneling your purchases in a more efficient way. Now, we could say, well, gosh, what happens? And I'm going to go ahead and put the other tax rate back and the term back because a lot of my clients are higher income earners and they do have responsibilities. What kind of rate of return? We saw that 5 was behind. What about 6? We're still behind. What about 7? We're still behind. What about 8%? We're still behind. So even if interest rates go up on this side and for some reason they don't go up over here, you're still ahead. But if fixed interest rates did go up, you would probably see some increases in your policy as well. But for the sake of argument, let's use a more realistic 23-year average of savings accounts rates, and let's just call it 2.5%. Over here, you have $192,000 of cash left over at the end of 23 years versus $350,000 of cash value, and this is with no increases over here. This is over 80% more cash value than cash simply by repositioning your money. And I often ask clients, which one would you rather be? Do you really want to continue to let banks and other financial companies reap the benefits from your savings, throwing you pennies in between your purchases? Or do you want to learn how to harness the power of compounding continually with an account that's contractually guaranteed to grow and knowing that you have contractual access at any time for any reason? Not only that, I know we downplay the death benefit, but just knowing that your savings account would basically double or more overnight in the form of a death benefit and come into your family's life when they need it the most, that's just something no other institution offers. It just doesn't happen. At this point, I'd like to invite you to come to our website and take a look at the openings in our calendar. Book a call for yourself with one of our team members so you can take a look at your number specifically to make sure that this will be applicable to your situation. What I can tell you, and I think what you've seen here, is for the vast majority of people, it's an absolute no-brainer and hugely advantageous to their wealth building efforts. We look forward to talking with you soon.